Over the past 40 years, investors, without even realizing it, have made one big change in how they invest in stocks. This difference has been huge, and I think it's fair to call it a mistake. There are many reasons for this change, but before I go over what it is and what are the fixes for it, it's helpful to know really what caused this and how we got here. One big reason is the rise of online brokerages and trading platforms like Schwab. In the early 70s and 80s, you had to go through a broker to get a trade done, to buy any stock or sell any stock. Don't get me wrong, online trading platforms have really been a net positive for investors. They've really helped democratize investing and make it accessible to everybody at a much lower cost. But when it comes to this one aspect of investing, you could definitely make the case for it that it has hurt investors. Again, I cringe thinking about the old school stockbrokers slinging stocks, cold calling with stock tips and hot IPO ideas. Painful to even think about. But the reality is, when it does come to online trading platforms, there was, again, this one aspect that they've caused a little bit of negative results for some investors. Another reason is free trading. It used to cost a fortune in fees and commissions to buy a stock or invest in anything. Now it's completely free. The fact that it's free has just reduced the friction of making a transaction, of taking action. When it's free and it costs us nothing, we're so much more likely just to, on a whim or based on some random piece of news, go in and trade our account and make some allocation change, even if there's not really a good sound plan or strategy behind it. Free trading, again, is a net positive for the end investor. It puts more money in your pocket and less in Wall Street's pocket. That's a great thing. But again, when it comes to this one detail around investing and the approach we all take, it has had a potential negative effect on people. Lastly, financial news takes a lot of blame here. We are living in a 24/7 news cycle world, and the same thing applies to financial news and media. We're constantly bombarded with market updates and economic updates. Even if you're somebody that was trying to avoid it, it's really hard to. It's always in your face, and the studies have shown that most financial media outlets skew negative. They sell based on fear, and that's how they know they'll get your attention, they'll get some clicks, and they'll get you to take action. This brings us to the big change I'm talking about. You might have spotted the trend here already, but really this big change in approach is that the average investor's holding period for stocks has dramatically shortened over the past 40 years. In the 70s, the average holding period of a stock was just over 5 years. That means when somebody was making an investment, they on average held it for over 5 years before they sold it. That's been on a steady decline since then. Once we've hit about the 2000s is when that holding period dropped below 1 year on average, and it's pretty much stayed there over the past 20 odd years. Where we are today, the average holding period for stocks for each investor is 10 months. This is crazy to me. 10 months doesn't even qualify you for the tax preferential capital gains treatment. By constantly buying and selling within your portfolio, investors are more susceptible to short-term volatility, short-term risks, and they increase the odds that they miss out on good market returns. As well, it just makes your portfolio less efficient. It has higher turnover, it generally has more costs involved, it incurs more taxes. There are very few positives that we can see coming from a holding period of, on average, 10 months for an investor. Each year, studies show that on average, each investor is underperforming just simple market indexes by 1.5% to 2%. And what's amazing is this even happens when they're owning a market index benchmark, so basically an index fund. Even investors in index funds are finding a way to underperform the market because they are continually trading in and out of this index fund, and they have a unique ability to always seem to find the worst timing. As investor sentiment is at all-time lows, is usually at market bottoms. As investor sentiment is at all-time highs, is oftentimes at market tops, and investors are constantly selling and transacting within their account, which is why you see the shortened holding period, and it's hurting their returns and performance. Now, we're way better off today with the tools and technology we have and the lower cost, simpler access to investing. There's no doubt about that. But there is this unique aspect of the old school way of investing that, again, created this friction. If you wanted to make a trade, you really needed to be certain about it. One, you had to contact a broker or a brokerage company to impart that trade for you.
4,000, that'd be 40,000 shares, John. Let me lock in that trade right now and get back to you with my secretary with an exact confirmation. Sound good, John? Great.
And second of all, the costs were so high. Nobody was winning with that situation. But there is this unique aspect where it really forced us to take a long-term approach to investing, and it forced people to make sure this was a wise investment that aligned with their goals. Today, you can just log into your phone, and again, in 30 seconds, you can buy a stock, sell it right away again for no fees, no cost, nothing. Lots of good of that, but plenty of negative as well. Your holding period of your investments is so important to pay attention to because it's been one of the only things that shows it can, over the long term, reduce the volatility you experience as an investor. If you were to try to invest and you just want to put your money in the market or a stock for, let's say, 6 months, it's about a 70% chance when you look at the broad market index that you'll have a positive return. When you go out over 1 year, you see that being about a 75% chance of a positive return. Now, the problem is that 75% chance of positive return, the deviation of returns is huge. It could be up 50%, it could be down 40%. There's a lot of rational people that wouldn't take that bet. Yet that is what most investors are doing day in and day out when they have a holding period of only 10 months. What's great to see is once you increase your holding period, once you get to 5 years and 10 years, and especially once you start getting out to 15 to 20, that's when you start seeing throughout the history of the market, 100% positive returns. What that means is anytime somebody's bought and held investments in broad market indexes, say the S&P 500, once you hold it over 16 years, there's not been one time in the history of the market that you've experienced a negative return. Again, that's amazing because the deviations of your returns start shrinking the longer you hold them. So that has an impact of reducing that portfolio volatility. So what can you do to fix this mistake? One option, focus more on index funds. There's no doubt owning individual stocks is far more volatile. And as a general investor, when you look at your options of what to invest in, owning index funds gives you instant diversification, helps smooth out that volatility, and it also allows the end investor to know, I own a basket of stocks across a whole bunch of different sectors. This is definitely a much more long-term play, and it should help you stay invested for the long term. Now, as I mentioned earlier, some investors trade in and out of index funds. There's no avoiding that sometimes, depending on people's preferences and behavior around investing. But for most investors, looking at an index fund in a more passive approach really can help extend that holding period and reduce the volatility that you experience. Another important step is to stop watching as much financial news. I know this can be hard. We all naturally think if we absorb more information, we'll probably learn more from this and we'll be able to get some action to take on our market to protect ourselves from a downturn or to go all in before we think it's going to go up. Financial news has very little relevance on our performance as end investors. They tend to skew negative and they tend to make us want to take more action, increase our stress levels, and make us want to tinker with our investments and portfolio more than we should, which again causes that reduced holding period. With that same theme, pay attention to how often you check your own portfolio. There have been a number of studies that try to show what is the optimal amount of time somebody throughout a year should check their portfolio, trying to find the balance of staying on top of things, knowing what's going on, but also reducing your stress. They've found that somewhere around quarterly to once every 6 months is actually a great cadence. Now that could seem like an eternity to some people. We all know people that log in, they start their day, they go and they check the markets and they scroll through and they see what's going on, thinking that's going to give them some sort of insight of what's going on in the world or what they should do with their portfolio. Again, it's not helping anything. It's only increasing stress. I use the metaphor oftentimes of take a look at Zillow. Would you log into Zillow every single day and check the value of your home? Or do you go every single day onto Kelley Blue Book and try to figure out what's my car worth? All that's going to lead is these feelings of, oh, I should have sold it last week. I could have bought it right back. What if I buy this? I see the trend, it's going up. You just got to find a way to stop it. It's not a healthy relationship with our money to log in constantly and always look at these day-to-day fluctuations. Again, you will see way more volatility over the short term when you do that, and it makes us want to take action. Again, all of these news cycles and this attention and 24/7 access, it makes us more susceptible to tinkering and making changes. And again, that reduces our holding period, which will reduce the likelihood of a positive return for you as an investor. Lastly, it's crucial to have a true plan for what these investments are for. I found it really helps people understand and give each dollar you have a job to do, right? Are you saving for retirement? Are you saving for kids' education, for a home down payment? What's the purpose of this money? And understanding the time frame you need it can really help put the news and all the attention around stocks and the volatility on the back burner for you. If you know that this money isn't needed for 30 years as for your retirement, it really helps you sit through a lot of the volatility and extend that holding period knowing I'm not touching this for years. Conversely, if it's short term, whether it's a home down payment, you need to take a look and make a wise decision on what's the best investment, knowing this is a short term holding. Is stocks best for me if I need this money in a year and a half? Probably not, right? Knowing what the money is for and having a goal around it will really help make sure you have a defined plan for what you're trying to achieve with this money, and it'll allow you to fix this short holding period most investors have today. I'll leave you with one of my favorite Warren Buffett quotes. If you aren't willing to own a stock for 10 years, don't own it for 10 minutes.